Gordon.
Two consecutive quarters of negative growth in America coming into the opening bell. Equity futures, they're positive on the S&P, up 0.2%. Apple and Amazon reporting after the closing bell a little bit later. That's the next stop, the next big stop for earnings. The Nasdaq down just 0.1% after the biggest one-day pop on the Nasdaq 100 going back to November 2020. So this is how we react to a downside surprise. Equities up, yields look like this. Your 10-year yield driving lower alongside your 2-year yield. Your 10-year down 11 basis points, your 2-year down even more. Euro dollar negative 1/3%, 101.68, and the crude market looks a little something like this. Backing away from 100, got close earlier, 98.97. We're positive about 1.76%. That's the cross asset price action. 20 seconds in, let's get you some movers. Here's Katie Greifeld.
Well, it's all about earnings this morning. Let's start with Harley-Davidson. It has my favorite ticker, HOG. It's absolutely soaring this morning. Second quarter profit and revenue beat estimates. Revenue for motorcycles rising, even though bike sales actually fell 28% in North America. Shareholders also cheering the CEO's turnaround plan. Ford also driving higher. It reported yesterday adjusted profit more than tripled to $3.7 billion. Sales rose even though car prices did as well. That's pricing power. Worth pointing out, though, that this is Ford's last earnings report before cutting thousands of jobs. Southwest Airlines, as you can see, not faring as well. Southwest, one of many airlines forced to delay and cancel flights that weighed on earnings, along with high labor costs. You can see that in the shares. They're down about 5%. And Best Buy, another pre-announcement of bad news, though you're not seeing it in shares this morning. Best Buy surprised with a cut of its profit and sales outlook, citing high inflation hitting demand. We heard pretty much the same thing from Walmart earlier this week, John.
Dare I say, maybe finally now it's priced. In fact, I won't say that at all, because every time we hear this, another time the stock gap's lower by 20%. Katie, thank you. We're about 1 minute and 30 seconds into this. We're positive 1/3%. Utilities top of the pile up by more than 2%. At the bottom of the pile, you see healthcare. That might change in a moment. Communication services down by more than 1 full percentage point. For GDP, it's another negative GDP print in America, reviving an old debate. Katie Lyons, is bad news good news?
That's the question. At least today, John, it appears that is definitely the case, because after two back-to-back quarters of negative GDP print, we have stocks continuing their rally from yesterday. We're up on the S&P, we're up on the Nasdaq, and you're seeing massive moves in the bond market as well, with the 10-year yield now down 12 basis points. We're at the lowest level since mid-April at 266, and the move is even bigger on the short end, down 16 basis points on the 2-year to 283. The question is this going to hold? Because if you look back at the moves we've seen over the last two Fed meetings, yes, we saw jumbo hikes and then jumbo rallies. It didn't hold the day after the May meeting or the June meeting. And historically, according to Bespoke, when the S&P rallies 1% or more on rate decision days, the next day's average has been a decline of 0.3%, with gains less than half of the time. And if you actually look at the following week and the time until the next Fed meeting, stocks are traditionally lower if we saw a 1% move or greater on the day of a Fed day. So we'll see if the pattern holds. We're ever higher now, right now, when it comes to equities, because of that bad news is good news story. Once again, that leadership coming more from growth instead of defensive. So the idea here yesterday being that maybe the Fed isn't going to have to move as aggressively, John.
Kelly Lyons, thank you. What a move we've seen in the equity market. Remember, the equity market on the Nasdaq bottomed the day after the Fed last met, the June meeting. This is what Katie's talking about in terms of these good days we've seen on Fed days. I can tell you that 2s and 10s, the 2-year yield, the 10-year yield, actually topped the day before the June meeting. We talked about that yesterday. So June 14th, the 10-year was 349.65. Right now, it's 265.61. Big turnaround, yields lower. Similar story across the curve on a 2-year. Right now, 283.79. The high, June 14th, 345.19. Big drop lower. Jim Bianco said it earlier. This Fed's going to become very, very data dependent, and we're going to be very sensitive to that incoming economic data. Though given that we don't have a clear idea of how they'll respond to that data, that's just going to amplify the uncertainty and the magnitude of the move. And Mike McKee, that's what we see again today in this bond market.
Yeah, you're seeing the bond market react, and I tell you, the bets, Fed funds futures on the September meeting have just fallen off a cliff, because people are at this point suggesting we're going to be in in recession and the Fed's going to have to back off. But as I've reminded you, we have a long way to go between now and September 21st. The GDP numbers were not good. We are at this point seeing down 9/10, of course, much of that inventories. So that could reverse, and we'll be 3/4 of the way through the second quarter, or third quarter rather, when we get to the next Fed meeting. And we have these numbers coming up ahead of the Fed meeting. So you're going to have a lot of data that could change people's minds. Now, when Jay Powell was talking yesterday, he said we're going to try not to contribute to volatility. They're not going to have a whole lot of choice about that, unfortunately. The market's going to react as the market's going to react because at this point, there's no more forward guidance. And so they don't know what the Fed is thinking. We'll obviously be paying a lot of attention to the Jackson Hole speech that Jay Powell will be giving at the end of August, and then all the Fed speak between now and then as people try to divine what's going on. Keep an eye on the Fed funds futures. They have obviously changed today, but they will change many times ahead, and we will see. You can see there the view of Wall Street is that the Fed is going to be much slower to raise rates, but we'll see if that changes. We get some strong numbers in those other data releases, particularly CPI. We
Mike,
could see that change.
The data ahead that you just put up for the next 2 months, there was one date that jumped out, and we talked about it in the last week. It's September 13th. CPI comes in a quiet period for the Fed. Is that going to make a difference, or do we have a new routine for this Fed now in a quiet period?
No, I don't think they'll do that again. I mean, it is really tough for them to do that and then retain credibility in what they're telling us going into the meetings if they want the markets to react correctly to what they're doing. But it is going to present a dilemma because it's in the quiet period. We're not going to know what they think about that number, and that's another reason for volatility ahead.
Got some volatility for sure right now in the bond market. Mike, thank you, buddy, as always. Let's work through this bond market. Yields lower by 16 basis points on a 2-year, 284, on a 10-year down 13, 266. Your equity market's doing okay, up 1/3 on the S&P. And Sam Linton-Brown of BNP expects you could see a whole lot more of the same. The risk rally is realizing. Peak cautiousness has provided the trigger. There is further scope for gains. Market technicals, positioning and valuation suggest risk assets can continue to gain. Sam joins us right now. Sam, good to catch up, sir, as always. Is bad news good news?
It is today. I think, look, our thesis here has been that the market is positioned very short risk, valuations are very depressed, and therefore that the bar for a trigger for a squeeze of that position into the summer is actually very low. And with the dovish Fed yesterday, where expectations had also built pre-meeting that we would begin to see some elements suggesting a less hawkish Fed going forward, that's provided that trigger for risk. And given that the market's still short, given that valuations are still depressed, we think positions can continue to squeeze into the summer.
Sam, when do we start to focus on why they'll be less hawkish, which is not because inflation's coming down, because we've just had a second consecutive quarter of negative growth in America. And in Europe, Goldman's calling recession this year. JP Morgan's calling recession this year. When do we start to focus on that?
It's the key point. And if we look back at what's happened since the June Fed, it's quite interesting because the first observation would be that inflation expectations in the US have actually gone down. The second observation would be that less tightening is now priced for the Fed. And those two observations combined suggest that the market prices a much weaker growth backdrop. The market's much more fearful of recession, of activity slowing down, as you're pointing out, and as the popular market narrative is. But if we then also look at the way risk assets are traded, there are stronger levels across both equities, credit, high beta versus low beta currencies, etc., than they were at the time of the June Fed. And so while, of course, to some degree, growth concerns are driving peak hawkishness, I think perhaps there's also something going on under the surface around the market's perception of inflation persistence. And we're seeing that in some of the PMI data, showing that supply constraints are beginning to ease. And to some extent, the market also might be questioning if the second round feed-through from higher energy prices is going to be as strong at the moment, given that growth is, of course, slowing quite materially. So I don't think the driver of peak hawkishness in the market's mind is entirely recession fears. Of course, that's a key part of it. But I think it's also partly less conviction in the persistence of inflation. And if that latter factor continues to drive the market's direction, then I think it suggests the risk rally has plenty of legs.
Break-evens speak to that story too. So Sam, if that's true, and other people disagree, but this is your position, so let's explore it. Where do you want to be in this equity market, and where do you want to avoid?
I think the key is the assets that are most aggressively positioned right now are those where we see scope for the biggest squeezes. So we'd sort of broaden the discussion beyond just the equity market. So in currencies, the market's very long dollars. We think that's a position that's going to be challenged over the next month. And it's long dollars against those currencies which typically go down most amid growth fears, such as the Australian dollar, such as the Norwegian krona, such as EM commodity exporters. We think those currencies will squeeze higher against a dollar that's weakening. In Europe, equity positioning, as we all know, is very bearish. And here we think that financials can recover. In the US, we like domestically orientated value. And that's a sector which we also think can outperform. Similarly, energy trades at multiples which we think are not justified in the current environment, and that's a sector in the US that we think can outperform.
Sam, that call you've got on banks, you know it's controversial. Can you tell me why the banks in Europe perform with an ECB hiking into a recession?
It's a question of how much is in the price. And I think the movement that we've seen in European yields, the popular market narrative about the growth backdrop in Europe, I'd argue it's really heavily discounted already into current market prices. You see that across a number of metrics, but one that we like to look at is equity risk premium in Europe. It's currently at higher levels than it was during the peak of COVID. And it means that in order to rationalize current prices, if you assume a normalization of that risk premium, earnings need to fall by an amount that's not only compatible with a mild recession in Europe, which looks likely, it's effectively our base case, but one that's a deeper recession in Europe. So the way that we'd advocate positioning portfolios is where you hedge the downside tail in Europe. Clearly, the energy crisis presents a very serious downside tail that one needs to protect against, but in a way that skews the core portfolio positioned risk on.
How do you navigate the redenomination risk that might come about on the periphery in Europe, Sam? How is that a factor in all this?
Ultimately, we think that the TPI introduced by the ECB in the medium term will prove to be credible. That said, the construction of it, where the threshold for activation might be high, it's very much discretionary, and the ECB have introduced a tool that in some respects is a little bit more reactive than it is preventative, at a time where idiosyncratic political risk in Italy is rather high, suggests the market's going to test the ECB. So we expect spreads to widen. We think Bund BTPs will trade out to 260 bits. That said, in the medium term, we don't think the market's going to be able to reliably price redenomination risk or systemic risk in Europe. TPI is one part of that, but also all of the supranational mutually assured issuance that we have as a result of NGEU is another part of it.
So many acronyms when it comes to Europe. Sam, appreciate it, buddy. You're an optimistic guy, that's for sure. Sam Linton-Brown there on Europe and the world and why he thinks this rally can continue. It's stalling now a little bit. We're unchanged on the S&P. We're negative 0.2 on the NASDAQ. We've talked a lot about this bond market. I'll keep pouring over it for you. We back away from the lows of the session. On the 2-year, we're down 13 basis points. The 10-year is down 11. That's how we respond to a downside surprise on GDP and a second consecutive quarter of negative growth. We send yields a whole lot lower. Coming up, investors look into Apple and Amazon results amid growing concerns about the US economy.
With the kind of concern over inflation and the economy, a lot of the focus is going to be on the outlook for next quarter. We're all looking for kind of tea leaves on what's the impact of economic weakness.
A conversation up next.
perpetual headwinds. That's kind of even an understatement. It's shocking the turnabout that this company has experienced. For much of its history, it was the most profitable public company, period. And here it is, like struggling to find its way with the uncertain future direction, a seemingly seriously challenged current business, and strategic problems really right and left.
Big tech in focus in a big way over the last week. Facebook yesterday, a little bit later today, all about Apple and Amazon. Right now, it's all about a second consecutive negative quarter of growth in America. This from Ellen Zentner of Morgan Stanley. 2Q GDP, technical recession confirmed. She goes on to say real GDP contracted in the second quarter, making a technical recession. We expect stronger growth in 3Q 22. We've got a statement from the White House. I've just gone through it and I can tell you the R word does not make an appearance. For more, let's get down to DC and catch up with Anne-Marie. Hey, Anne-Marie.
Jonathan, they're going to do everything they can to avoid the R word. I mean, do you remember the Carter days when Alfred Kahn didn't want to use the R words? We Carter calling a recession a banana. We're almost at that point with this administration. This is what the president has to say this morning. Coming off of last year's historic economic growth and regaining all the private sector jobs lost during the pandemic crisis, it's no surprise the economy is slowing as the Federal Reserve acts to bring down inflation. The president is making it clear he wants the Fed to be independent, but they certainly want inflation to come down. That has been the top priority of Americans when you look across the polls. But in doing that, there's always been this risk that there would be a very, very narrow landing of potentially avoiding a recession. Right now, what we have today is showing that we have 2 quarters of back-to-back negative growth. Common rule of thumb, that is a, quote, technical recession. This administration is going to do a lot of work over the next 24, 48 hours to tell you it's not.
The political spin commences down in DC. I have to say, it already started in the last week before we even got the number. Anne-Marie, great work as always. AMH going through some of this reaction. She'll do that all day for you on Bloomberg TV and on Bloomberg Radio. The economy's slowing. We can all agree on that. Mark Zuckerberg can too. Over at Meta, Facebook, this is what he had to say. We seem to have entered an economic downturn that will have a broad impact on the digital advertising business. The situation seems worse than it did a quarter ago on the West Coast. Let's get to Ed Ludlow. Hey, Ed.
Yeah, good morning, John. Meta declines have accelerated beyond 8%. That puts the stock on track for its worst performance since February, which you'll remember was when they reported fourth quarter earnings where growth stagnated. And so the drama of what we're seeing play out, you read the Wall Street reaction and there is a smorgasbord. This was the first ever quarterly decline on the top line for Meta, and you heard what David Kirkpatrick had to say about the company's history. But the street sees a smorgasbord of issues. The changes that Apple made to its iOS privacy tracking still continues to hurt this company. And what's so interesting for the Facebook parent is the impact of the stronger dollar also weighing on the company. You know, how often have we heard that in the last week alone from the likes of Microsoft and, of course, the likes of Alphabet also flagging that. On days like this, you look at those numbers, John, I like to go to MODL Go once we've had the earnings print. So the deviation between the top line of what they posted in consensus was marginal, 0.4%, but you go straight to ad revenue and it was much wider, 1.4%. It's simple. There is a pullback in the advertising industry due to the macro picture that Zuckerberg outlined, but they're also competing for smaller budgets, and it seems, based on the commentary of the earnings call, that names like TikTok are winning out against Meta and Facebook now really pivoting to Reels. The problem with Reels, and I don't know if you're a user of that product, is that it's yielding a much lower revenue per user or per ad than the rest of the Facebook platform historically has done. So a lot of problems here and no immediate sign that things are going to improve.
I'm happy to say that app is not on my phone. Ed, thank you, buddy, as always. Ed Ludlow on the West Coast. There's going to be a whole lot more a little bit later. Ed's going to be a busy man. Katie Lyons has more. Hey, Kaylee.
Hey, John. Yeah, $7 trillion worth of market cap is reporting today in the S&P 500. More than a third of that is just 2 companies, Apple and Amazon, a whopping 10% of the S&P 500. And both stocks are down today ahead of their results. What's interesting, though, is coming into today, Apple was actually up 15% in the month of July, heading for its biggest monthly gain in 2 years. So that raises the bar to a certain extent. as the company faces challenges including cooling consumer demand in the face of inflation, both demand and supply issues in China stemming from the COVID-0 policy, which is why starting tomorrow, some of those top-tier iPhones are going to go on sale in that market. And a stronger dollar, a headwind too, as Ed was just mentioning. Put it all together, revenue is expected to be up 2%, earnings down 11%. For Amazon, earnings expected to fall 31% as they deal with higher costs on labor and freight, while revenue is expected to be in the single digits for the third quarter in a row. We're really looking for a read on the consumer as well as the job market from Amazon, because not only is it one of the biggest market-weighted companies out there, it's the second biggest employer in the United States. And we already heard from them that they overhired during the pandemic. They're looking to make adjustments. So any commentary around that will be closely watched. And I would bet by the White House too, John, because taking a look at that statement they just put out on second quarter GDP, the president talking about a historically strong job market, consumer spending still growing. I wonder to what extent Amazon is going to be a tell on how much or how little that is still true.
Interesting. We got a hint from Walmart earlier this week, didn't we? Kelly Lice, thank you. May 4th, the Nasdaq was up by 3.41%. That was a Fed meeting day. June 15th, it was up by 2.49%. That was a Fed meeting day. On May 5th, the day after the Fed meeting, we were down 5%. On June 16th, the day after the Fed meeting, we were down 4%. Today, the Nasdaq 100 is down 1% after being higher by 4% yesterday. You get the picture. It gets choppy, the 24 hours around the Fed. And I said yesterday, don't define a Fed meeting by some intraday price action. It's going to all be about the data. GDP this morning, then it's on to the ISMs next week. We get CPI on August 10th. Tomorrow, the employment cost index too. The ECI coming right up. I'll drive you through the trading diary, the events you need to be watching very shortly. That's next. This is Bloomberg. Is bad news good news? The answer to that seems to change every 10 minutes right now. Right now, it's bad news. We're down 0.6% on the S&P 500. On the Nasdaq, we're down by more than 1 full percentage point. For the bond market, seemingly it means fewer rate hikes. 2s, 10s and 30s. 2s down 12 basis points. 10s down 12 basis points. That's the price action. Here's your trading diary. After a second consecutive quarter of negative growth in America, Secretary Yellen's got things to say. 1:30 Eastern Time. The president has things to say as well. 2:15 Eastern Time. We'll get some earnings from Apple and Amazon after the close a little bit later. European bank earnings continue Friday with BNP Paribas and Standard Chartered. We round out the week with PCE and UMich Consumer Sentiment Survey on this side of the Atlantic and CPI on the other side. From New York City, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, July 28th. Here are the top market stories that we're following for you at this hour. If it acts like a recession, contracts like one, is it one? Second quarter GDP disappointing as growth shrinks for a second quarter. Everyone agrees the economy is slowing. How much and for how long? And markets just whipped by data and earnings, yields sinking. Traders expect the Fed funds rate to peak out at 3.25% this year. Equities reverse those earlier gains. And super earnings Thursday. U.S. and European companies worth more than $9.4 trillion report earnings today. We got you covered with executives from Ford, Shell, Frontier, and Stellantis. From New York, I'm Alex Steele with my co-host in London, Anna Edwards. Guy Johnson is off today. Welcome to Bloomberg Markets. Anna, take your pick on what to focus on, but the market action is very clear. Buy bonds, particularly the front end. The stock reaction still iffy, but is the bad news good news is what we're trying to digest.
Yeah, on a day with so many earnings, it's almost like maybe we're getting a cleaner picture, a cleaner response to the data in the bond market. That seems to make more sense based on the weakness in the GDP data that we saw. But of course, when you look at equities, you might have thought that the bad news would be good news, but then Meta is pretty mega when it comes to tech stocks, and that's weighing on everything.
Yeah, I loved it. Was a meta worse was what we were talking about here. And I should point out that U.S. mortgage rates in the 30-year actually fall to 3.5%, the first decline since early July. I don't know. The housing market is still slowing. 5 handle is still quite a large one compared to the fact that my rate a year and a half ago was 2.85%. It's still a steep move there. So you can expect the housing market potentially to continue to contract, and you saw that within that second quarter GDP data, Anna.
Yeah, absolutely. We seem to have had so many conversations about the data. We've got a focus on the U.S. economy, of course, a focus on earnings. Now, the U.S. economy shrinks for a second quarter, fueling concerns of a recession. At yesterday's Fed news conference, Chair Jerome Powell repeatedly said, we're not there.
We're not trying to have a recession, and we don't think we have to. I do not think the U.S. is currently in a recession. I don't think the U.S. economy is in recession right now. It doesn't seem that the U.S. economy is in recession right now. We don't say there is now a recession, that kind of thing. All I've really said is I don't think it's likely that the U.S. economy is in a recession now.
I'm not sure how many times he was asked about and said the R word. Seemed like plenty. That brings us to our question of the day then, Alex. If it acts like a recession and contracts like a recession, is it a recession? Of course, the counter might be, is it walking and talking or quacking like a recession with the jobs market as it is? Let's discuss. Joining us now, Megan Swiber, Bank of America Global Research U.S. Rate Strategist. It was described to me as just a journalistic label earlier on, Megan. So maybe this doesn't matter to you whether we're in a recession or not. The data is the data, and that's what you're working off. You weigh in, though, on whether you think this is a recession.
Yeah, I think so. Our economists generally believe that we're going to be landing ourselves in a recession by the end of this year. Whether or not Q2 puts us there, is a moot point. One thing that we haven't really seen slow yet, of course, is the employment data. That's likely to come in our expectation, probably more so in the coming months. But yeah, this is actually helpful for the Fed in terms of them wanting to get inflation under control, right? The method that they're going to use to do this is slowing the economy. And that negative GDP number is a reflection of that.
So the only thing that was really holding it up was the 1% increase in personal spending, and that was mostly driven by services. Yeah. But people are drawing down their savings now. It's at the lowest level since 2016, and then prices are continuing to stay high. At what point do you think that also rolls over?
Yeah, so right now people are really trying to keep up with the increases in prices that we're seeing across oil, food, clothing. And at some point they're going to have to shift their spending to discretionary things, right? Currently people are trying to take that summer vacation, enjoy the next few months. But once we move to the fall period, that's really when we're going to anticipate this slowing in spending on services. And hopefully, in our view, the inflation data is going to reflect that as well, because services is really still coming in so hot on the inflation numbers as well.
Megan, how do you think that, what is the Fed's reaction function to us going into a technical recession? We've heard a lot about, well, we heard Jerome Powell being asked and talking a lot about how he doesn't think that we're really in a recession. And I'm sure that, we've heard a lot about how they're focused on inflation. And yes, they acknowledge weaker data, but maybe that was the market clutching for dovish straws. Do you think then that the Fed, how far away is any Fed pivot around the weakness in this data, given the political pressure that will build if we are labeling this a recession?
Yeah, I think that's a very important question here. So yesterday, I would say that we're beginning to hear some signs of that Fed pivot, right? Powell really endorsed this message of data dependence. It's not just this blind march to a higher policy rate. Now they're at a setting that they would consider neutral, within the range of neutral. And they're going to have to be a little bit more thoughtful from here about whether or not to continue to deliver these supersized rate hikes. And we saw the market consistently, interpret that message as a bit dovish yesterday. We're, of course, continuing to see that in the price action this morning. And that steepening of the Treasury curve is really reflecting that. Just uncertainty around what the Fed is necessarily going to have to do at the September meeting.
At the same time, he talked a lot about referring to the summary of economic projections from the last meeting, which would imply continued rate hikes in 2023 when the market is not expecting that. So I get in some extent why it was taken dovishly, but what's the room for a hawkish surprise now?
Yeah, so, Alex, I would say that it really is just going to come down to the inflation data and the employment data. Between now and September, we get 2 more CPI releases, we get 2 more payrolls reports. That's going to be how the Fed is going to decide what comes next from here. Now that they're in this comfortable range of neutral, it's the question of how much more hawkish they will need to be. And that information will come down to how quickly the economy is indeed slowing, because that's ultimately how they're going to be able to fix this inflation problem.
Megan, what kind of delay, what kind of lag do you think about when you think about how effective Fed policy is? Because that's a sort of disconnect, isn't it, between data and Fed reaction. I wonder what kind of lag we should assume.
Yeah, that's a very important question here too, and it was something that Powell specifically pointed to in the press conference yesterday, which made us interpret his responses a little bit more dovish there. I would say Fed policy kind of happens in 2 different channels, right? It's their communication about what's going to come next, which is what the Treasury curve is pricing. As Alex just pointed out, we're already beginning to see those mortgage rates come down a little bit on that anticipated Fed turn that we're likely to see in the second half of next year. But you also need to consider the impact that they've had already on the Fed's balance sheet, on the hikes that have been delivered. I would say that lag probably, the pass-through to the economy is not necessarily immediate. You probably see that in about 6 to 12 months time in the turnover in the inflation numbers.
Okay, so should we have 2-year yields currently priced right now at 2.86%?
Yeah, I would say that it really comes down to what you anticipate the Fed to do over the next few months here. Right now, I would say that if you're anticipating this Fed that will only peak out at around 3.5% as we do, and then need to cut in the second half of next year, that number seems pretty consistent with that path. If indeed, Alex, though, we don't see those inflation numbers come back down, that really leaves that hawkish room for the market to need to price a more aggressive policy path from here. But really, it's in our view, we need the 2-year rate does reflect our baseline expectation for what the Fed's going to do, but there is still so much uncertainty, which comes down to the inflation numbers.
And does the 2-10s inversion still make sense, Megan, and the extent that we're seeing of that inversion?
Yeah, and I think that's absolutely correct. We anticipate that the 2-10s curve will continue to reflect that inversion, continue to flatten, and that's really because of what the Fed needs to do here, right? They need to be able to bring rates to a more aggressive policy stance, which is what the market's currently reflecting, but at the same time slow growth. And those growth slowdown concerns are usually more so felt in longer dated tenors. So think 10-year, 30-year, and out. And that's really the core reason why you're going to be seeing this inversion, because the market's going to have to price the Fed cutting from that aggressive stance as they bring rates back down when the economy cools, and ultimately, in our view, we end up in a recession.
All right, Megan, thanks a lot. We really appreciate it. It's a lot to kind of understand and a lot of confusion to Megan Swiber, Bank of America Global Research U.S. Rate Strategist. Thank you very much. So coming up, it is more our question of the day and then how it relates to the equity market. If it quacks and talks like a recession, what do you do with stocks? Emily Hill, Bowersock Capital founding partner, will be joining us for her take. This is Bloomberg.
Fed makes its call.
The committee raises the target range for the federal funds rate.
75 basis point hike.
Bloomberg is there with live coverage.
We're moving expeditiously.
But where are you in the journey?
We're not sure.
And instant expert analysis.
The answer would be easy if the Fed wasn't so late.
If we start to see real softening, we'll have a different conversation at the Federal Reserve.
They're massively constrained by the real economy.
Nobody covers the Fed like Bloomberg, your global business authority.
After this run-up we're getting in the stock market and the bond market right now, that by next week we're going to be sitting around and questioning, are they really being credible?
That was Guggenheim CIO Scott Minerd casting doubt on the Fed's credibility after hiking rates by 75 basis points. Let's go back to the question of the day here. If it acts like a recession and contracts like a recession, is it a recession? I want to put that question now to Emily Hill, Bowersock Capital founding partner. Emily, answer the question and then how it relates to the equity market. Looking at big tech, down over 1% this morning.
Well, the answer to your question is yes, but I don't think we are in a recession now. As Chairman Powell said yesterday, it's not up to the Fed to call a recession. I think I will be very surprised if we don't have a recession at some point in the next 3 to 6 months. But now we're not seeing one.
So now you're not seeing one. And how does it relate to equity markets, Emily? When you think about one looming, in your view, 6 months out, how do you position for that?
I was very surprised. I shouldn't say very surprised, because there seems to be a pattern that's getting established, but to see the market rally so much yesterday over what was basically a non-event. The Fed did exactly what everybody expected it would do, raised rates by 75 basis points, declined to give further guidance, said that they were going to, act one meeting at a time. And so we are in the camp that believes this is a bear market rally. I think it's going to be very difficult for the Fed to get inflation down to its target without having unemployment rise to the 5 to 6% level. What does that mean in terms of equity markets? We are recommending that people stay defensive, and if they're not currently defensive, get defensive. Yesterday was a selling opportunity in our view, and frankly, we like the parts of the market that generate cash flow, that are defensive, that will potentially hold up well during a recession. And so yes, I think the equity markets have gotten ahead of themselves.
So sell the rips, Emily. What does that mean then when you're looking at, say, the bond market? It just seems, I mean, the indication yesterday was very clear. By the front end, we're going to see a dovish pivot if we're already at neutral for the Fed. So what do you do in bonds?
We saw $170 million in outflows in bond funds through the end of May. And frankly, I think while we haven't seen capitulation in the equity markets, I would argue that we've seen them in the public bond markets. You know, the typical high-quality U.S. tax-free bond fund is down 8 to 9%. The typical diversified corporate bond fund is down around 10%. It's been, you know, in the view of some, the worst bond market since the 19th century. So we actually see publicly traded bonds as a buying opportunity, not because you're going to make a ton of money in bonds, but because we expect them to go back or to revert to playing their more standard role in portfolios. One of the reasons we saw such massive wealth destruction in the first 6 months of this year is, you know, both stock and bond markets were down, correlation spiked. We think that correlation will drop. And so as long as you're remaining relatively defensive in the bond market, you know, we think this is actually a good time to be increasing positions in fixed income.
Emily, back to stocks. I wonder how granular you get when it comes to adjusting portfolios to pick stocks that you think will actually manage to ride out the storm better than others. I picked out a part of my conversation earlier with the CEO of Stellantis. This is Carlos Tavares, who was talking about how companies and supply chains have been disrupted. Let's listen.
We see a big competitive gap between those who are now able to control their own supply chain and create the appropriate buffers that protect their customers like us, and those who are still unable to do so. So it's now a very competitive landscape at tier one supplier level where you see big gaps in terms of expertise to control the supply chain.
So there's a CEO, Emily, talking about the importance of picking your suppliers carefully, picking the ones who've proven themselves most able to deal with supply chain issues. Are you in a position where you're assuming that inflation stays around for a while, and so it's important to pick those companies that can handle it?
Yes, I think, you know, when you look at the market expectations for inflation over the long term, they're still relatively low. And I think what the market is not pricing in is continued supply shocks. You know, what makes us think that the type of supply shocks that we've seen in the last couple of years are going to lessen in frequency? You know, if you look at what's happened to agricultural commodities around the world, geopolitical turmoil, what the impact of climate change, and simply the disruptions to supply chains that are coming from weather. I think it's very important to be invested in the type of company, and we're very long-term investors. We're not investing for the next 3 months or 6 months, that are large global multinational companies that have the ability to at least influence their own source of supply. And so in that category, I would put companies like Honeywell, John Deere. I completely agree with that commentator and the need for control.
Where does that leave then technology stocks? There's chatter that now you want to start maybe owning a little bit of growth, particularly if eventually we're going to wind up in a recession, and those are the big multinational guys.
Yes, I do think, you know, not quite yet, but companies like Amazon, Apple, Microsoft, you know, the big tech companies are, you know, they're not going anywhere. Just because they're growth stocks doesn't mean they're not good investments. And, you know, it's important to have a diversified portfolio. The growth side of the market, there are some very good opportunities simply because, you know, as always, investors have stampeded for the exits and, you know, discarded a fair number of really reasonably priced tech stocks simply because interest rates are rising, and therefore, we're going to assume that the entire sector is going to do poorly. So I do think that selectively buying the tech sector, even the communications services sector, and growth stocks generally are important to any portfolio because, of course, we could be wrong about a recession. We could be wrong about long-term inflation pressures.
Okay. And we're seeing them very differently affected by the ad spending trends that we're seeing at the moment. Emily, thanks so much for joining us. Emily Hill of Bowersock Capital with her thoughts on the markets. Still ahead, US President Biden and Chinese leader Xi Jinping are holding a call. Started nearly 2 hours ago. If it's still going on, it's nearly 2 hours long. It's their first conversation since March and is happening a few days before a possible trip to Taiwan by House Speaker Nancy Pelosi. More on the politics of that next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. For the first time in at least 17 years, Comcast Internet business added no new customers last quarter. That has shares falling today. Comcast also said that subscribers to the Peacock streaming service stayed relatively flat. The money-losing service had seen a surge earlier this year due to the Olympics. Spending jumped 18% on MasterCard's network in the second quarter. Consumers flocked to take trips following 2 years of pandemic-related lockdowns. That led MasterCard to boost its forecast for revenue growth this year. MasterCard and Visa take a slice of the purchase price each time consumers use their cards, so the payment giants are benefiting from higher prices. And that is your Bloomberg Business Flash. Alex?
All right, thanks so much, Angel. Let's go to D.C. right now. Lots happening there. President Biden and China's Xi Jinping are holding a call. Now, it started about 2 hours ago. According to the White House, the call is meant to keep relations stable. Bloomberg's Anne-Marie Hordern is joining us at the White House. Anne-Marie, what do we think is happening right now?
Well, it's the fifth time the two have spoke. Most recently, they spoke only in March, and there's obviously been some fresh tensions between Washington and Beijing leading up to this call, and this is most notably that potential trip people were talking about for Speaker Pelosi. Now, we don't know she's going to go there. There's no announcement from her office. The official trip right now, of what we have learned, includes Indonesia, Japan, Singapore, maybe Malaysia, but right now, no Taiwan. But already we saw China really come out aggressively say they are preparing for that, and they do not want Speaker Pelosi to visit Taiwan. And of course, this is going into this meeting with Xi Jinping and President Biden. And of course, Alex, the other big topic we'll be focused on is tariffs. The administration for months has been talking about whether or not they were going to lift some of those Trump-era tariffs because they are working on fighting inflation. We still don't know yet what the president has decided. This is something, of course, China would want to see.
Anne-Marie, good morning. We saw this climate bill, a surprise compromise between Joe Manchin and President Biden. I say a surprise because certainly the stock market reaction we've seen in wind power companies and solar companies here in Europe suggests it was unforeseen.
It was a surprise, Anna. I mean, many in the political circles who have been working down here for decades were even caught off guard that Senator Manchin and Senator Schumer over the past few days, because remember, Senator Manchin said at this moment with inflation, he could not get on board yet especially with the energy provisions, especially with some tax provisions. They now are able to come together for something that would go through the reconciliation budget process. And this deals with clean energy, so a lot of money going into the climate space to fight climate change. This deals with Medicare provisions and also has some tax hike provisions. So it's not the Build Back Better dream they had from the progressive wing of the party coming in to the Biden administration, but it is something before the midterm elections. It was a win for the White House.
Yeah, it is something. Emery, quickly, can it pass? I mean, senator after senator seems now to have COVID, and you got to be in person to vote.
So that's one issue, right? The logistics of this. In the Senate, you have to be in person to vote. And then again today, we had another senator, Senator Durbin, say that he has contracted COVID. But also, more importantly, Kyrsten Sinema of Arizona, when she was asked about it, she says, I have to read the text. She's been very weary of doing anything in sort of tax hikes. The Trump-era tax cuts will still exist, but she needs to read the text before she can get on board, and they need her vote.
Okay, thanks so much. Bloomberg's Anne-Marie Jordan with the latest there from Washington. We'll keep monitoring for developments, for news, for the readout, essentially, from that call between President Xi and Biden and bring you any details of that when we get it. Coming up on this program, we'll pivot to aviation. JetBlue acquires Spirit Airlines after Spirit's merger with Frontier is called off. We will discuss all of that with Frontier's CEO. This is Bloomberg.
At that all day yesterday.
All right, we're an hour into the U.S. trading session. I mean, whippy doesn't feel like the correct word to describe what's happened in the last 24 hours. Bloomberg Kriti Gupta is tracking some of those moves, with the NASDAQ now really rolling over.
Completely rolling over, but it kind of makes sense a little bit. You had an over 4% gain at the close yesterday in the NASDAQ, so it's completely natural to see a little bit of a pullback. There is a little bit of an earnings picture to it, though. Well, let's just talk surface level. The S&P 500 down about 0.6%. Underperformance is the name of the game when it comes to the NASDAQ, as Alex pointed out. Once again, it does come down to earnings. You did have a couple of them. Today, the outperformer, though, is a little bit of a defensive tilt, just not your traditional tech. You are seeing utilities outperform up about 2.2%. Even the 10-year yield, people diving back into treasuries. And I think that 2-year yield in particular, that's very important when it comes to the GDP story. We are in an official, a technical recession. The official recession, or whether or not it's a call that will be made further down the road when dealing with that recessionary dashboard, things like layoffs, things like business investment, financial conditions, among others. But for now, on that news that we did have that contraction for a second quarter, you did see the front end of the curve catch a little bit of a bid. So those yields are down. Certainly something to keep an eye on. But let's bring it right back to the stock market here, because once again, that tech underperformance, I think, is the equity story. A lot of it has to do with earnings. Remember that Alphabet and Microsoft strength of 2 days ago, that did not carry through. In fact, you have Meta Platforms down, talking about a weak forecast when it comes to subscriber count. Remember, they also have a major demographics issue when it comes to attracting ad spend. So a double whammy there. Qualcomm as well, talking about a weak forecast, talking about slowing demand for those chip sectors. So down about 7% there, and not creating a great environment for Apple and Amazon after the bell. Remember, together they make about over 10% of the S&P 500. They're also macro proxies in a lot of ways. Amazon for the consumer, Apple for business investment. So we are certainly going to keep an eye on that. And then lastly, with the major merger story of the day, let's talk airlines here. Spirit Airlines now actually saying, well, we're not going to merge with Frontier anymore. We're going to merge with JetBlue instead. Remember, they are still at the whim of that antitrust scrutiny. JetBlue already dealing with some regulatory scrutiny with American Airlines in particular. So you do see Spirit up about 2.6% once again on that merger arbitrage deal. JetBlue is down about 3%, as is traditional for any M&A deal that you really see.
Kriti, thanks very much. Yeah, Bloomberg's Kriti Gupta on the markets, and finishing there in the aviation space. Let's pick up on the story she was just mentioning. JetBlue is acquiring Spirit Airlines for at least $3.8 billion in cash. The deal is announced less than a day after Spirit called off a planned merger with Frontier. Joining us now is Barry Biffle, the CEO of Frontier Airlines. Barry, really nice to have you with us. I'm sure you're disappointed that the plans you had with Spirit have not come to pass. We'll talk about your plans without them shortly, but I wonder if you could just fill us in on when was it? What was the point at which you realized that a deal with Spirit wasn't going to happen?
Well, clearly, I mean, it became clear in the last few weeks that it likely wasn't going to happen. And, you know, we're excited about today because while we're disappointed in the deal not going through, this paves the way for Frontier to be the low-cost carrier in the United States. So this is a windfall for our shareholders. It's great for our employees, and really the consumers on the Spirit side are the only ones that really lose. They're going to have to pay a lot more money, over 40% more once they merge with JetBlue. But that's why we're growing as fast as we can, and we're offering 1 million seats starting at $19. Yes?
You guys fought really hard, though. So this, I understand the positive spin. I promise you that we will get to that. But you guys fought hard. I mean, the vote was pushed back 4 times. It really did feel like it came down to the wire. What happened, and why wouldn't you increase your offer to really seal that deal?
Well, look, I mean, our board, I'm proud of them. They took a disciplined approach, and we weren't going to overpay for Spirit. I mean, we believed in the merits of the deal that we put forward, but in the end, the Spirit shareholders voted for JetBlue, and hey, you win some, you lose some, but at the same time, we still win by being the ultra low-cost carrier. This is paving the way for us.
So talking about overpaying, how much do you think that JetBlue is overpaying?
Look, I'm not going to get into what I think they're overpaying, but we offered what we believed was a compelling offer, and you know, they're not going to benefit from the upside in the travel recovery that we're just in the early innings of. But look, people wanted the cash today. Unfortunately, they don't get the cash today. They don't get the cash until it actually goes through. But like I said, we're disappointed, but the outcome isn't terrible for us.
Right. Will it get through regulatory hurdles, do you think, Barry? Will you be lobbying? Will you be pushing for it to be blocked on those lines?
Look, I'm not going to speculate about what's going to happen on the regulatory process with them. I mean, we're here to talk about Frontier and what we have in the future, and I wish them luck.
To that point, though, I mean, it feels like they're going to have to spin off some stuff or divest of some assets. Are there assets that you might be interested in that they'll have to spin off that you might then want to buy?
Oh, absolutely. I mean, I don't know about buy them, but we will. Like I said, we're going to be the ultra low cost carrier. I think the government, I think consumers, I think everybody would want us to have their position in LaGuardia, for example, and they've said that they would give that up. So we would probably be the first one in line to be after that.
Okay, I read some analysis by an analyst at JP Morgan today, Barry, about your business. It says that you inherit the keys to the low-cost kingdom in the United States, kind of along the lines of what you've just been telling us. So what do you plan to do with those keys?
Look, we're going to grow as fast as we can. We just announced our first profitable quarter since the pandemic began. Our revenues were up 43%, which is a record. I don't think anybody in the space is actually that high. And look, we continue to expect to expand our margins through the end of the year, and we expect to get our cost near pre-pandemic levels in 2023 at sub 6 cents. So, we're really excited about the future, and I think that's why Jamie Baker and JP Morgan is so bullish on us.
There's also been some rhetoric I was reading about how the fact that the fight for Spirit was also really about pilots. And we've seen in the recent turmoil in travel here and over in Europe that there are just not enough staff. Do you have the staff to be able to expand at the rate that you want right now?
Yeah, actually, we have a slight surplus today, and we have a really good pipeline. In fact, we just announced a cadet program yesterday that will train you from 0 hours, take about 2 years to get you into the cockpit of our planes. But I think one of the biggest things, because of this, this announcement of JetBlue and Spirit, they're going to be much slower growth, which is going to make us a much more attractive landing place for new pilots, because you're going to upgrade that much faster to captain just because of the growth rate. So I think we're in a really good place, and I'm not really sure that we weren't merging just to solve the pilot problem. We were merging to save consumers money.
Barry, given what we've seen in terms of revenge tourism, I know it's been dubbed by some since the pandemic, so many people wanting to fly again. I'm not sure if you're a very good bellwether because of that for the consumer in the US and for what they do and don't want to, or how confident they're feeling, I suppose. I wonder if you feel like you're in a recessionary environment right now, because the data suggests that the US is in a technical recession, and yet some people tell us, including the chair of the Federal Reserve, that he doesn't think it really is a recession.
Well, look, I think the challenge is we've already had the biggest recession in travel over the last 2 years. We're coming out of that, if you want to get to the facts. And generally, when you have a recession in the U.S. airline industry or anywhere in the world, you end up seeing capacity shrink and supply shrink. We've already kind of got that embedded in because of the pandemic. We're still considerably below 2019 levels and very much below what we should have been with GDP growth. So you've already kind of got that capacity cut in. So you have constrained capacity. That's what's giving pricing power to the industry. But that's why we're so important to consumers. I mean, we are the low fare option, and we have seen evidence that there are some pressures. I mean, we're seeing much higher incomes. Our $100,000 household income is up considerably. Our $200,000 household income is up considerably, which kind of gives you a clue. You see this when people are feeling squeezed, and so they still travel, but perhaps they look for better value and don't have to pay as much on their air travel. And so we're the beneficiary of that.
Even higher income then will trade down. Hey, Barry, to that point, I was talking to the Visa CFO yesterday, and he was saying that the travel numbers are amazing, but he has really limited visibility and that people are booking a lot later and sort of closer to their trip time. So he doesn't have the visibility out more than like 30 days. Do you?
No, we don't have huge visibility either. I mean, we're selling August now in a big way and a little bit of September, but we don't see a lot beyond that. I will tell you, however, we do have other indicators. We spend a lot of time with hotels in Vegas and Orlando and so forth. They're seeing big increases in group and meeting travel. So it looks to be a very robust fall. So I think you're going to see kind of that next leg up, if you will, with small business and business travel continuing to expand. And I think that will actually kind of fill any voids if we see any kind of slowdown in the leisure space.
Hey, Barry, we really appreciate your time today. I know it's been a long few months for you. Barry Biffle, Frontier Airlines CEO, thank you so very much. All right, coming up, we're going to stay in the C-suite here. Ford shares are surging after the strong earnings. It's focusing on its EV future and flashing jobs for that EV shift. We're going to speak with its CFO, John Lawler, coming up next. This is Bloomberg.
you up to date with the news from around the world. Here's the first word. I'm Angel Feliciano. The U.S. economy declined for a second straight quarter, raising the chances of a recession. GDP fell at an annualized rate of 0.9%, following a 1.6% decline in the first 3 months of the year. The report showed decreases in business and government spending and residential investment. U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart about a deal to free imprisoned basketball star Brittany Griner and another jailed American. Bloomberg learned that the U.S. would swap them for a Russian arms dealer it holds. Moscow says there's no deal yet. And the maker of Fiats and Jeeps expects to overcome supply chain issues to extend strong earnings into the second half of the year. Stellantis report for first half earnings that were better than expected. North America remained the company's standout region, bolstered by the Jeep SUV and Ram truck brands. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex?
All right, Angel, thanks so much. Let's get back to the market here. So NASDAQ 100 down by 1.1%. Meta CEO Mark Zuckerberg sounded the alarm yesterday on the call. He said that the country has entered an economic downturn. Here is part of what he had to say on that call.
We seem to have entered an economic downturn that will have a broad impact on the digital advertising business. And it's always hard to predict how deep or how long these cycles will be, but I'd say that the situation seems worse than it did a quarter ago.
And this is the company reported its first ever quarterly sales decline. And then we get more big tech after the closing bell today. Amazon and Apple and Intel. Bloomberg's Ed Ludlow joins me now. Ed, a word on Meta for a second. Zuckerberg was really blaming the lack of performance on an economic issue. Some of the analyst rhetoric was that it was more of an engagement issue. Walk me through the two.
Yeah, I mean, what's interesting, the basics are that ad budgets are shrinking, right? And if you're an advertiser, you have to choose where to put your money. Earlier in the week, we kind of got this sense that Google search was a place that was winning. Facebook platform is not winning, right? You know, there's a real emphasis on the movement to Reels, short-form video, but executives explain that the problem with short-form video is that they're just not able to command as many dollars for those ads, even though revenue is growing in that unit as well. But I read across the sell-side reaction at least, and there's a smorgasbord, right? And one thing that really jumps out at me that we cannot underestimate this week is the impact of the stronger dollar, because there were currency headwinds for Meta as well, along with the ongoing impact of Apple's iOS privacy changes, which continue to come up time and again on these earnings calls for Meta.
Well, let's go from Meta to Apple and things that they've been doing, having an impact on others, of course, over on the West Coast. And also that FX element that you mentioned, Ed, could be a feature of the Apple numbers as well.
Yeah, I think what's interesting about Apple is that if there is a bright spot, the hope is that it will be in non-hardware, right, in the services revenue. That's where if we see any growth from Apple, it will likely be there. Remember that we don't have guidance for this period. It was suspended, but Apple had told us that there would be negative revenue impact of $4 to $8 billion, as much as $8 billion from ongoing supply chain impact. And I'm excited. You know, last week I was jazzed. This week I'm excited because Apple gives us the global consumer lens. So important to know what's happening in China. They haven't got any new products in the quarter, new products to come later. There is a timing element, but we get a good sense of how the smartphone market's doing, how the high-end PC market's doing through Apple.
And that's a kind of, you get both also really with Amazon. And I'm wondering, has the market sufficiently priced the risks of a recession and a consumer slowdown?
Yeah, interesting because Amazon's been relatively transparent on the impacts of inflation already, right? It's raised Prime subscription prices, not just in the United States, but in Europe as well. The kind of wild card is that we've had Prime Day in the early part of July. We're waiting on second quarter earnings. Did consumers wait to spend during that Prime window? And, you know, always looking for a bright spot. The difference with Amazon is that while they kind of fight inflation on the consumer side that should impact growth for Amazon.com, they have AWS and the cloud business to offset that growth impact. So that's what the street will look to. I think that hopefully from both Amazon and Apple, we get a lens to the second half of this year. And the R word, recession, you know, Mark Zuckerberg was pretty explicit, economic downturn. Whatever your definition of recession is, things aren't great. And Tim Cook has often often resisted the urge of speaking too big about his view on the world economy. In fact, if I remember rightly, he said, "I am not an economist" on the last earnings call. Well, I certainly hope he will be this evening.
Okay, Ed, thanks very much. Bloomberg's Ed Ludlow with details on the tech sector, of course. We will come back and talk about autos. This is Bloomberg.